Good morning, traders. It is 8:04 a.m. Chicago time on Wednesday, the 15th of February 2017. It's 9:04 a.m. New York time. Thanks for joining me this morning. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Uh, what can I say? These trader bites are getting really boring because we're just continuing to do the same thing day in day out. So yesterday we continued the rally. Um, we pushed to 2338 in the S&P futures. It's just the way it is. So I'm going to keep this real brief today. I'm going to say that my primary hypothesis for the day is to buy the first dip and then turn off my screens and go take a nap. Um, that's pretty much the only profitable plan right now. I'm just being facetious. This is definitely a fairly historic move here that we're witnessing, and it's not my style of trading, and so my input here I feel is really redundant and repetitive and not very useful to you, other than to remind you that uh, to not be complacent and to only trade when you see an edge that you believe fits your plan. Again, I want to remind everybody that trading is not an end all. You know, it doesn't it doesn't either work or doesn't work. Trading is like nature, like life itself. It operates in cycles. Sometimes things work out your way, and they're smooth, and sometimes you have to be patient and kind of sit through. And the times we learn from the most are these times when we have to be patient, when our weaknesses and mistakes and errors in trading are exposed. So I didn't intend for this session to start off as a trader wisdom session, but I want to remind everybody this is the time, especially for day traders. Investors are doing very well, especially if you're long. But for traders, I want to remind you this is, in my opinion, the most dangerous time for survivability, because this is when traders get complacent. The market's inducing us to become complacent here. And in general, this is when the turns are near. The point of our exhaustion of our patience is when things tend to change. So let's get back to our trader bite. In general, the market sentiment overall is mixed to lower. The Dow Jones are up 3 points only. The futures are trading at 24.85, and the only other futures that I'm watching are euro stocks and the dollar that are up. Everything else is negative, including gold. Gold being down 28 to 30 basis points, $3.50, and the Russell lagging everyone down 9.9 points this morning. The S&P is trading the lower end of the range. Yesterday, the S&P closed near highs and continued, as we would normally expect, and continued its move higher as it established a high volume node near the high yesterday, and that energy seems to have dissipated overnight. This looks to be setting up to be a reversion day today, so we might see some pretty decent opportunities here. Who knows? The overnight news flow is very light. Yellen spoke yesterday to the Senate, and then she continues her Humphrey Hawkins testimony to the House, so look out for that. It'll be broadcast on CNBC and other networks. She'll be asked more questions. These hearings seem like an incredible waste of her time. It's just the politicians trying to be political about finance. Um, so Yellen, the key thing she said yesterday was that waiting too long to raise interest rates was unwise and could cause a recession. So the mood in the FOMC favors continued growth in the interest rate, which would be, I think, good for the economy. We need it. We need a risk premium on our money. Um, it helps lubricate the financial system. So, and that's probably why, part of why, other than the deregulation promised by our president, that's probably why these bank stocks have been going crazy. Also, overnight, the UK unemployment rate hit its highest point on record. The UK added 37,000 jobs in the last 3 months, ending December. It posted its sixth consecutive quarterly gain. The British pound is down 0.3%, trading at 124.28. Let's see if that is accurate. Yes. And then other than that, it's pretty much a few stocks here and there. The Hang Seng is up strong, topping the Asian indices, and the CAC 40 out of France is topping the European indices. And then earnings from Pepsi and Groupon expected to come in. I think they may have come in. And in other news, looking at the news flow, we just got the U.S. advanced retail sales month on month, very strong number, 0.5% versus 0.1%. And then February Empire Manufacturing came in at 18.7 versus 7.0. This is the highest number, or the highest on record, since September 2014. CPI also came out much, much stronger, doubled the expected, 0.6 versus 0.3. X food and energy, 0.3 versus 0.2. So that's that. As far as what we're expecting today, and I lost that screen. As far as what we're expecting today, in about 4 minutes, we get industrial production, U.S. industrial production for January. The consensus is 0.0%. Cap utilization also at the same time, expectation is 75.4%, prior 75.5%. And then at 10 o'clock Eastern, we got U.S. business inventory 0.4% for December, and also NAHB housing market index for February, expecting 67.0. We get gasoline, crude, and distillate inventories. Gasoline inventories at 10:30, expecting 500,000 surplus. Distillates expecting a deficit of 1 million barrels, and crude oil expecting a surplus of 3.5 million. And then right at the close, a minor release, we get the total net tick flows. This is the amount of capital moving in and out of the U.S. That comes out at 4 o'clock, no expectation. Again, look out for Fed's Yellen at the House Financial Committee panel at 10 o'clock Eastern. Fed's Rosengren at noon. And then at 12:45, we get Fed Speaker Harker. And so we have a slew of releases this morning to look out for. I guess Daniel won that bet. So let's move on to what we expected yesterday. My brain is slow this morning. It's too much going on. So here's the primary expectation yesterday. We were looking for the market to dip down towards 23.22 and to turn and push higher after a corrective move, after a corrective pullback right here. Push higher into new highs. That was the primary expectation. The secondary expectation is to just trade sideways, never cross into the lower distribution down here, trade sideways, and then we would have a stronger move up from the open. That was hypo 2. Remember, the bias is really, I don't see a reason for bias to go short based on yesterday's configuration that you see here. We still have a gap zone below us. The market's very, very strong right now. I'm not big enough to initiate a trend down, so why would I fight the market, right? I know a lot of people like to. And then the third hypothesis, which is the ideal situation for day trading, and what we've all been waiting for, is a push higher that fails to take out the prior day's high at 23.29, and then starts to rotate through, targeting the prior day's low and in the mid of the gap zone. That was hypo 3, which clearly did not work out. Here's what actually happened. So So as we watch the market open here, 23.75, and we push forward, we see the market pushing down, and you can see here, there's the point of control from the prior day. There's the test of the point of control by a tick or two, and then the market finds its bidders. This is a classic. This is classic um, auctioning. This is your first indication that buyers have stepped in. Why? Because this is the largest rotation of the day so far, 4.5. That is just inside of one standard deviation, two standard deviations. This is considered the beginning of an impulsive move. The expectation is a pullback and continuation higher. Let's see what happens here. It fails, and then we have a second stab at this. There it is, an even bigger rotation higher. So the buyers seem to hold on to control here. What threw me off is this strong push down, 5.25, that makes you kind of stand off a little bit, stand back. But then here it is again, 5.75. So the expectation is for chop, pullback, and continuation higher. Again, waiting for that trade. And it happened, but it was just so slow and painful. And so we end up pushing all the way through to new highs. 23.37 or 75 is the high. And we end up with this weird kind of triple distribution type of profile, with the prior day's high being the low volume node. This becomes a key area to test today, 23.29, expecting a little bit of support there. The key support, though, for today's session is right down here. Um, this area right here, this whole consolidation, the top of it is the 23.26 and a half, 23.26 and a quarter area. This is an area. If we do fall, I'm expecting a bounce and a reversion back towards the high volume node if we continue lower. So based on yesterday's trading, there's nothing here yet again that says, hey, we may be selling soon. So as I extend this profile forward just to track where the volume is on the trend, we see that the point of control is not shifting, and we continue to build, to push, create a low volume node, consolidate, consolidate, low volume node, consolidate, low volume node, consolidate, low volume node, consolidate, low volume node, consolidate. This is typical trend behavior, right? Chop, 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 push, chop, 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 push, chop, 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 push. I know you're doing the dance right now in your seat as I say that. Um, so that's how things are. Not my fault. It's just a crappy market for day trading, to be honest. Um, but here's what we see. Here's the little light at the end of the tunnel here. We open up, we test lower, and then we push on this spike to new highs. We have some pretty good volume on that spike. You can see the little nub of a volume bar there. Uh, and then it just fails. There's no continuation there, and a complete failure to continue higher. This looks like the market is likely to test and push down into the 23.26 and a quarter. This is the expected trade today. This looks like it's not. I'm not saying it's exhausted. I'm not saying go mortgage your house, take the money out, and sell short here. I'm just saying that this looks like the beginning of an exhaustion, and it's opening up probabilities, higher probabilities and potential for some selling today. I expect us to remain inside of today's range. Remember, the market generally does not trend, and then the next day just drop. It tends to trend. Then you have an inside day. If not, you have a bearish engulfing day, an inside day, and then the beginning of the next cycle. Okay, so I think it's kind of silly, and I'm seeing signs of this, that people are just coming in and they're going, yeah, it's once this falls over, it's just going to be one huge, bearish bar closing at the low here. That rarely happens without a catalyst, and the catalyst comes in the form of news, and there's just no news there unless Trump hits the red button that says nuke on it. There's really no news here that would cause this kind of a move. So more likely, what you would see is a pattern that that essentially takes that same move, right? So we're trending up. Let's put a higher tail on this. And then we're continuing to trend up. Like yesterday, we finished at the high. And what you might see is something that looks like that or that finishing near the lows. In other words, the market goes up, finds rejection, and comes near the lows and closes near the lows. Then you have your next day pulling back, the people looking for a bargain, and then again you'd have the trend starting to move down, and you have one time framing down. Okay, I'm not particularly saying that Trump would do such a thing. I'm just saying it really for this type of market, it would seem like it would take a whole lot of bad news to make a move happen. I'm not turning into this into a political discussion. Obviously, it doesn't matter in finance here. Um, so that's that. Again, the hypo that worked out yesterday. And again, despite what some of you might think, I'm not saying I'm right when I say the hypo worked. There's nothing right about it. It just is. Hypo 1 was in play yesterday. It pushed down, found a bottom, had a failed low, and rotated higher. The other hypos did not show up or work out as expected. Today, and we'll review the weekly come tomorrow. Today, it's looking like it's likely to have a quick push up on the open, and I'm looking for a failure pattern. I'm looking for a push to 26 quarter pullback attempt into the pullback into the prior HVN, and then I'm looking for a ride down into this point of control, which brings us. Remember yesterday's point of the prior day's point of control and yesterday's point of control in the same place. This is likely to be a very strong magnet today. So this is what I'm expecting. I'm looking for it to push down into this 23 area today. I'm looking for a small regression back and recovery from the trend up. Okay, so that's the primary hypothesis. Failing that, if we push lower into the 29 and find a base, then we're likely to push new highs, and that would be hypo 2. Okay, and then hypo 3, instead of selling, the more probable play is a deeper push. So it just kind of messes around a little bit, open auction, gets into a deeper push into 26, and then just basically sits sideways for the rest of the session, staying inside of the prior day's range. That is hypo 3. Okay, a strong selling hypo would be hypo 5. And that would take us back to the point of control, the MC point of control at 1275. I would love to see that, but the more likely plays are 1, 2, 3, 4 today. Does this mean that the market will do exactly as I'm expecting? It does not. These are simply ideas and targets for what the market is likely to do so that I can align myself using order flow to enter and to place my orders for the most likely exits as I scale out of the trade. That's the whole point of this trader bite, is not to predict. My goal is not to predict what the market is going to do, and despite the comments I see on Twitter, it's not to prove myself right to the audience here, to the folks here watching. That's not the goal here. The goal here is to come in with some kind of plan, plan to negotiate the movement in the day, so that you're not trading out of your gut, from your gut, and you're not trading emotionally. You're simply following whatever you expect it to be the plan. Remember, you're not the same person before, during prep, as you are after. Okay, so having a plan is much more important than coming up with one while you're in the trade, because your mind doesn't operate the same way. That's all I had for you for today. Good luck. It's the same old story every day. I know it is. For those of you who missed the Bookmap webinar, the professional series they did with me as a guest, that professional series continues throughout the rest of the week. If you missed it, in the description for this stream today, you'll find a link to the video. I think you might find it interesting. I demonstrate how I'm using the theoretical average to manage my risk in a trade. That's a concept that you haven't heard about anywhere else, I'm sure. And I'm sure it's going to become common now, but it's an important thing for you to look at and see how we manage trades with size, or risk with size, when we're trading multiple lots. It's an important concept to grow into, and it's your goal in the short term if you're trading one or two lots right now. Good luck, and I'll catch you tomorrow. Take care.